Welcome back to the Deep Dive. We are opening the books today for a very specific mission. If you were tuning into this one, chances are you have a date with destiny coming up, or, more accurately, a date with the Certified Equity Professional exam.
That's right. We aren't just browsing today, we're studying. This is for the practitioners.
We are tackling the industry standard, the Bible, really, Accounting for Equity Compensation, the 20th edition by Barbara A. Boxa, and we are zeroing in on the foundation, chapters 1 through 3.
Right.
Now, I know the temptation is to skip the history lesson in chapter 1 and just jump straight to the math, but looking at the notes here, that seems like a mistake.
It is a huge mistake. I mean, these first 3 chapters are the bedrock. If you don't understand the history of why the rules changed or the strict definition of a measurement date, all the complex calculations later on are just going to look like a random number.
So you need the logic before you can do the math.
Exactly. You need the logic.
So the plan is simple. We're going to trace the evolution from the old rules, that's APB 25, to the current standard, ASC 718. Then we'll break down the massive divide between equity and liability awards.
That is critical.
And finally, we'll get into the weeds of Chapter 3 regarding grant dates.
Which is where the trickiest exam questions usually hide.
Perfect. Let's start with the time machine. Chapter 1 takes us back to what some people call the good old days and what accountants might call the Wild West.
Yeah, that's a good way to put it.
I'm talking about the era before 2004. Walk us through the landscape under APB opinion number 25.
Okay, so APB 25 was issued way back in 1972. And for, over 30 years, it was the law of the land. The core concept you have to grasp here is intrinsic value.
Intrinsic value.
Right. Under APB 25, compensation expense was calculated as the market price of the stock minus the exercise price right on the grant date.
Okay, so let's apply that. If I'm a company in, say, 1999, and I grant an executive a stock option with a strike price of $10, and the current market price is also $10, that's an at-the-money option.
Yep.
What's the intrinsic value?
It's 0. 10 minus 10 is 0. And that was the beauty of it for corporations. Because the intrinsic value is 0, the compensation expense recorded on the income statement was 0.
So you could hand out millions of dollars in potential wealth to employees, claim a tax deduction when they exercise those options later, but your net earnings reported to shareholders remain completely untouched.
Exactly. It was effectively free money on paper. There was no hit to the P&L, your profit and loss statement.
Wow.
Now, there were exceptions. I mean, if you issued discounted options where the strike price was lower than the market price, you had to record an expense for that discount.
Sure, that makes sense.
Or if you had performance-based awards where the number of shares wasn't known yet, that triggered variable accounting. But for the standard plain vanilla stock option, it cost the company nothing in reported earnings.
I can see why companies fought tooth and nail to keep that rule. It seems like a massive loophole.
Yeah.
But obviously, the accounting world eventually woke up.
Well, they said, wait a minute, these options definitely have value.
Right.
That happened in the early 90s. The FASB, the Financial Accounting Standards Board, started the push toward fair value. They argued that just because the intrinsic value is 0, that doesn't mean the option is worthless.
Oh, of course not. An option gives you the right to buy stock at a fixed price for 10 years. That time value has to be worth something.
It has economic value, and this is where the political drama kicks in, right? The 1993 exposure draft.
A war zone, I read.
It was a war zone. FASB proposed that companies must expense options using a fair value method, basically using a model like Black-Scholes to put a price tag on it. Corporate America revolted.
How bad was it?
The FASB received over 1,700 comment letters, and they were hostile. There was intense lobbying in Congress to strip the FASB of its power if they went through with it. The argument was that expensing options would, destroy the tech industry and ruin American innovation.
So the FASB blinked.
They had to compromise. In 1995, they issued SAS number 123. Now, note this is not the rule we use today, but it was the bridge. SFAS 123 said, we encourage you to expense options using fair value. But if you don't want to, you can stick with the old APB 25 rules.
But there was a catch.
There is always a catch. If you stuck with the old rules, you had to include a footnote in your financial statements. A pro forma disclosure.
Ah, the dreaded footnote.
Exactly. You had to say, here are our earnings, $100 million. But if we had actually counted the cost of our stock options, our earnings would have only been $80 million.
So everyone could see the cost, but it didn't officially lower the earnings per share.
Precisely. And for about a decade, almost every company chose the footnote method. Why voluntarily lower your profits? But then we hit the 2000s.
The dot-com bubble burst.
Enron, WorldCom. There was a renewed focus on transparency. Plus, the International Accounting Standards Board, the IASB, issued IFRS 2, which required expensing. The U.S. couldn't be the only major market ignoring the cost of equity.
Enter SFAS 123R, or, as we know it in the codification today, ASC 718.
Correct. Issued in 2004. This was the end of the free lunch. It mandated that all share-based payments to employees' options, RSUs, ESPPs, must be recognized as compensation expense based on their fair value.
And that brings us to the modern era. Before we leave the history, though, are there any major differences between the U.S. standard, ASC 718, and the international one, IFRS 2, that candidates should flag?
They are very similar, but for the exam, you need to watch out for Employee Stock Purchase Plans, ESPPs.
Okay.
Under IFRS 2, ESPPs are always compensatory. You always have to record an expense. But under ASC 718, if an ESPP meets certain strict criteria, like a small discount, usually 5% or less, and no look-back feature, it can be considered non-compensatory.
Meaning no expense.
Meaning no expense recorded. It's a crucial nuance.
So in the U.S., if your ESTP is stingy enough, it's free, accounting-wise. Okay, let's move into Chapter 2. Overview of the standard. We've established everything must be expensed, but there was a significant scope change recently that might trip people up.
Yes. This is the ASU 2018-07 update. This is a big one. Originally, ASC 718 strictly covered employees.
Right.
If you granted options to a non-employee, like a consultant or an advisor, you had to use a totally different standard, ASC 50550.
And that old standard was messy, I take it.
It was a headache. You essentially had to mark-to-market the options every quarter until they vested. So if your stock price went up,
Your expense for that consultant skyrocketed.
exactly, it created massive volatility.
But the 2018 update fixed this.
It did. It brought non-employees under the ASC 718 umbrella. So now, generally speaking, you treat a consultant stock option just like an employee's. You measure the value once at the grant date, and you lock it in.
That must have simplified things immensely.
It did, and it removed a lot of that volatility for companies that use a lot of contractors.
Okay, so employees and consultants are now largely in the same boat.
Yeah.
Now let's talk about the two different oceans they can sail in. Equity versus liability. This seems to be the single most important classification concept in the book.
It is the golden rule of equity comp accounting. Every award you grant falls into one of these two buckets, and the accounting is just drastically different.
And if you get the classification wrong,
Your financial statements are wrong. Simple as that.
let's start with the equity bucket. What defines it, and why do CFOs generally prefer it?
An equity award is, well, it's typically settled in shares of stock. Think of a standard stock option or a restricted stock unit, an RSU. The defining accounting feature here is that the expense is fixed
Fixed at what point?
at the grant date.
Yeah.
You calculate the fair value on that specific day, say it's $10 per share. You lock that number in.
And that's it.
That's it. Whether the stock price goes to $100 or drops to $1 over the next 3 years, your compensation expense for that award does not change. You just recognize that fixed $10 value over the vesting period.
That explains the preference. It's
Yeah.
predictable. You can forecast your earnings.
Right.
Now, contrast that with the liability bucket.
Liability awards are the chaotic sibling. These are awards that are typically settled in cash or where the structure forces the company to treat them as like a debt until they are paid. The key accounting feature here is variable expense.
So we don't just measure it once?
No. You measure the fair value at the grant date, but then you must remeasure it at the end of every single reporting period, every quarter, until the award is finally settled.
Let's play that out. If I have a cash-settled liability award and my stock price doubles in Q4.
Then your compensation expense for that award essentially doubles in Q4. You have to take a much larger hit to your earnings just because your stock price went up.
And I guess if the stock price crashes,
You might actually get to record negative expense, a credit to earnings.
it introduces volatility into the P&L that has nothing to do with your actual operations.
Exactly. And investors generally hate unexplained volatility. That's why liability classification is usually avoided unless it's absolutely necessary.
Okay, so sticking to equity seems like the safe play. But getting into that equity bucket requires nailing down the grant date. This leads us into Chapter 3. The text says grant date isn't just a date on the calendar.
No, it's a rigorous definition. This is where the exam gets really technical. You can't just say, the board met on Tuesday, so Tuesday is the grant date.
So what are the criteria?
Under ASC 718, you only have a measurement date when 4 specific criteria are met, and they have to be met simultaneously.
Let's run through them.
1. A mutual understanding of the key terms. 2, the company is contingently obligated to issue the shares. 3, all necessary approvals are obtained. And 4, the recipient begins to benefit from or be adversely affected by changes in the stock price.
I want to drill down on mutual understanding. A lot of people assume this means the employee has to sign the grant agreement.
That's a common trap, yeah. In the corporate world, you usually don't need a signature to start the accounting clock. If the grant is unilateral, meaning the company just gives it to you, the grant date is typically the date the board approves it, provided the company communicates the grant to you within a relatively short time period.
Define relatively short. Are we talking days, weeks?
The standard is a bit vague, but general practice is that you can't sit on it for months. If the board approves a grant in January but doesn't tell the employees until June, you likely do not have a grant date in January.
So the grant date and the stock price you use would slide to June.
Right, which could be a disaster if the stock price jumped 50% between January and June. Your expense just went up 50% because you forgot to send an email.
Wow. Okay, so communication is key. What about the approvals criteria? Where do companies mess this up?
The biggest pitfall is shareholder approval.
Wow.
Let's say a company runs out of shares in their stock plan. The board says, we grant 100,000 options to the CEO, subject to shareholder approval of the new plan at the annual meeting.
The board has approved it. The CEO knows about it. Seems like you're good to go.
Yeah. But the shareholders haven't. And since the company cannot legally issue the shares without that vote, there is no contingent obligation. You do not have a grant date until the shareholders vote yes.
So the expense just floats until the annual meeting?
Yes. You're marking that award to market, treating it like a liability, essentially, until that vote happens and establishes a fixed measurement date.
Okay, another scenario from Chapter 3. Undefined targets. We grant you 1,000 shares, and the performance goal is, well, we'll decide the goal next quarter.
Same problem. If the terms aren't defined, there is no mutual understanding. If you don't know what you have to do to earn the shares, you don't have a grant date. The accounting clock stays paused.
So this leads us back to the liability triggers. We said cash settlement usually equals liability. Is it always that black and white?
Not quite. The exam loves the choice nuance. You have to ask, who has the choice to settle in cash or stock?
Okay, scenario A. The employee gets to choose. I want my bonus in cash or shares.
That is a liability. If the employee can force the company to pay cash, the company has a liability on its hands.
Okay, scenario B. The company gets to choose. We will decide whether to give you cash or shares.
That is generally an equity award. The logic is that the company can always choose to print more shares, which is equity, rather than spend its cash.
Is there an exception to that?
Yes, the substance over form exception. If the contract says company choice, but the company has a history of always paying cash to everyone.
Ah, so their actions speak louder than the words in the contract.
Exactly. The auditors will step in and say, look, your past practice shows you intend to pay cash. They will reclassify it as a liability.
Now, we have to talk about the repurchase obligation. This is the famous 6-month rule. I found this fascinating.
This is critical for private companies.
Yeah.
Often a private company wants to control who owns its stock, so they might issue shares but attach a put option, a rule that says the company must buy the shares back.
So the employee gets the stock, but can force the company to buy it back.
Right. Now here's the rule. If the employee can force that repurchase within 6 months of the shares being issued or vesting, it triggers liability accounting.
Why 6 months? Why that specific number?
It's basically a line in the sand drawn by the regulators. The theory is that to be a true owner of equity, you must bear the risks and rewards of ownership. If you can just turn around and sell it back to the company a week after getting it.
You're not really bearing any risk.
None. You're just holding a substitute for cash. The regulators decided that 6 months is the minimum time required to establish that you are bearing market risk.
So if the repurchase happens 6 months and 1 day later.
Then it stays classified as equity. You held the risk long enough.
So for the exam takers, under 6 months equals liability. Over 6 months equals equity.
Correct. And remember, this applies if the employee has the option to force the sale.
One last specific scenario from the text that feels like a trap. Broker-assisted cashless exercise. This is how most people exercise options. I don't have the cash, so the broker sells some of the shares to cover the cost. I get the rest. Technically, cash is moving around. Does that trigger liability?
No, and that is a very important distinction. In a broker-assisted exercise, the broker is a third party. The company issues the full amount of shares to the broker. The broker then sells them on the open market and pays the strike price to the company.
So the company isn't using its own cash.
Exactly. The cash comes from the market, not the company's balance sheet, so it remains an equity award.
All right, we have covered the history, the classification buckets, and the measurement date minefield. I think it's time to test the listeners.
Let's do a lightning round.
Okay, I'm going to throw out 3 scenarios based on what we just discussed. Listeners, try to answer before our expert gives the verdict. Ready?
Let's do it.
Question 1. We're back in 1995. A company grants a standard at the money stock option. Under the old rules of APB Opinion Number 25, how much compensation expense does the company record on its income statement?
The answer is generally 0. Remember, APB 25 used the intrinsic value method. Market price minus exercise price. If they are equal, the value is 0, no expense.
Question 2. Fast forward to today. Under ASC 718, you grant an equity award, let's say an RSU. You measure the fair value at the grant date. The next day, the stock price triples. Does your compensation expense amount change?
No. The expense for an equity award is fixed at the grant date. Subsequent changes in stock price do not impact the expense amount. You ignore the market fluctuations.
Question 3. A private company grants shares to an employee. The contract states that the company must repurchase those shares for cash upon vesting. The employee cannot hold the shares. They are cashed out immediately. Is this equity or liability?
That is a liability award. Because the employee is cashed out immediately, they never bear the risk of ownership for that required 6-month period. It's a cash settlement mechanism disguised as stock, so you have to market to market.
If you went 3 for 3, you were definitely on the right track for chapters 1 through 3.
And if not, don't worry. That's why we have the study guide.
So, to wrap this up, we've seen that accounting rules aren't static. They evolve. We went from a world where options were free under APB 25 to a world of strict fair value under ASC 718.
And the takeaway isn't just memorizing the rule numbers, it's understanding the goal. The goal of ASC 718 is transparency. It ensures that shareholders can see the true cost of paying employees, even if that payment is in stock rather than cash.
It's about making sure the financial statements reflect reality.
It is. And if I can leave you with one final thought to mull over, think about that 6-month rule we discussed.
The risk rule.
Yes. In the accounting world, ownership isn't defined by having your name on a certificate. It's defined by risk. If you aren't exposed to the downside, if you aren't sweating a little bit when the market dips, then the system says you aren't really an owner. It's a fascinating philosophical stance that applies to more than just accounting.
Ownership requires skin in the game. That is a great place to leave it. Good luck to everyone studying for the CEP.
But keep crunching those numbers and watch your measurement dates.
We'll see you on the next Deep Dive.